Tuesday, June 30, 2026. I mean, this was supposed to be the day, right?
Oh, absolutely.
Yeah.
The day the market had circled in bright red marker for months.
Exactly. We were supposed to get concrete dates for the Western supply rebuild, but instead, the day just comes and goes, and it's met with this deafening silence.
Yeah, and it's fascinating because what we're looking at here is the absolute definition of an execution gap.
An execution gap. Right.
Yeah, like you have a market that's priced for a rapid supply rebuild, but then it just runs face first into delayed corporate announcements and missed government deadlines.
It's wild. Well, welcome to this deep dive, everyone. Whether you're actively tracking commodity cycles for your portfolio or, you're just trying to understand the future of global energy, this week is honestly a masterclass in market expectations.
It really is. I mean, it's a perfect case study.
Yeah. And our mission today, using the Uranium Unleashed midweek review for the week of June 29, is to unpack that execution gap you just mentioned. Like, what actually happens when a market priced for perfection just hits a wall?
Right. And to understand why the market was so disappointed by what didn't happen this week, we really have to look at what the market is doing right now.
Which is basically nothing, right? Just waiting.
Exactly. Consolidating and waiting. I mean, let's look at the numbers. The spot price closed Monday at $85.10 a pound.
$85.10. And it's been stuck there for a while.
Yeah, flat for 5 consecutive weeks. It's completely trapped in this super tight $1 band between $85 and $86.
Wow. 5 weeks in a $1 band for a volatile commodity is crazy. Why is it so locked in?
Well, because no utilities are buying spot in massive size right now. I mean, they're already long on their term contracts. And on the flip side, no producers are discounting their material because $85 works perfectly fine for their economics.
Right, they have no incentive to drop the price.
Exactly, so they just sit.
Yeah.
But here is the critical part. While spot is at $85.10, the long-term price, the term price, is sitting up at roughly $95 a pound.
Okay, wait, so that's a huge spread. That's a $9.90 spread between spot and term.
Yep, $9.90. And a lot of people might look at that and think it's a bearish signal, but it's actually not. That spread is the entire structural thesis of the market.
How so? Like, why would a buyer willingly pay almost $10 more per pound?
Because they're paying for delivery certainty. Remember, there is no major new Western mine coming online before 2028. None.
Oh, wow.
So buyers are looking at that 2028 supply cliff and saying, I will gladly pay a massive $10 premium today to guarantee that fuel's actually there when my reactor needs it.
That makes total sense. It's like buying an airline ticket, right?
I mean,
like paying that $95 term premium is like buying a fast pass or a guaranteed reserve seat on a flight months in advance. You pay top dollar because you know you're getting on that plane.
Oh, that's a great way to look at it, yeah.
Right, but the spot market is like flying standby. Sure, you might get a slightly cheaper ticket at $85, but if you're a utility running a baseload nuclear reactor, you cannot run your operations on standby supply.
Exactly. You can't just hope the uranium is at the terminal. You need it guaranteed. And so the market was patiently paying that $10 premium, just waiting for a concrete construction date to prove this supply rebuild is actually on track.
Which brings us to Tuesday, the day that was supposed to give us that date.
Right. NexGen Energy's annual general meeting in Vancouver.
Okay, let's unpack this. Because procedurally, this meeting was a massive success, like a total home run.
Oh, absolutely flawless on paper.
Yeah, they had 458 million shares represented, which is almost 70% of the total. They elected 9 directors. PwC got reappointed as their auditor with like 99.94% support.
Right, and the rights plan was renewed at 98%, clean across the board.
Super clean. And we're talking about Rook I here.
Right.
This is the largest undeveloped uranium deposit in the Western world, right?
By far. Well over 100 million pounds of indicated resource sitting right there in the Athabasca Basin.
And they already have their Canadian Nuclear Safety Commission license. They got that back in March.
Right. The CNSC license is in hand. Yeah. The final adjustment decision is made. They are ready to go.
So everything is perfect. But the missing piece, the thing that caused this execution gap, was that the AGM just came and went without a concrete commencement date.
Yep. Total silence on the exact timeline.
They just left it at that vague summer 2026 guidance.
Exactly. The guidance is still on the books, but there is no specific day for when they actually break ground. And here's why that matters so much.
Yeah, break it down for me.
The project itself is not in trouble. The permits are fine, the economics are intact, but this AGM was their highest profile, most visible investor-facing moment of the entire year.
Right. Everyone was watching.
Everyone. So missing the opportunity to announce a date on that specific stage shifts the biggest near-term bullish catalyst from the delivery column straight back into the expectations column.
But let me push back on that for a second. If a company gets literally 99.94% approval for its auditor, and they run a perfectly clean governance meeting, shouldn't investors just be thrilled?
You'd think so, yeah.
Right. So why is the market treating a boring, successful AGM as a failure just because they didn't get a specific Tuesday on a calendar?
Because the market is incredibly impatient, and capital has an opportunity cost. Investors aren't paying a $10 term premium for good corporate governance. They're paying it for pounds out of the ground.
Got it. So without a date, the narrative just kind of stalled.
It stalls completely. And it wasn't just corporate Canada that left the market hanging on Tuesday.
Oh, right. The U.S. government also totally dropped the ball on a major deadline.
Yeah, showing that these execution gaps are happening across both the private and public sectors simultaneously.
Okay, so let's get into the public sector side. Tuesday, June 30, was the Department of Energy's statutory deadline to make the final 10 metric tons of HALEU available.
Right. HALEU, which is high-assay, low-enriched uranium.
Right. And this was supposed to complete a congressionally mandated 21 metric ton program. Because they'd already done, 3 tons back in September 2024?
Yep, and then another 8 tons in December 2025. They were perfectly on schedule up until now.
And with those previous tranches, they made a big deal out of it, right? They named the recipients TerraPower, Kairos Power, Westinghouse, and Terra's Nuclear.
They had huge press releases. It was a massive PR win every time.
But then Tuesday hits, and as of Wednesday morning, literally nothing. No DOE press release, no named recipients, no public confirmation at all.
Just statutory silence.
Yeah.
And you have to understand why HALEU is so vital to contextualize why this hurts.
Well, wait, let me ask for some clarification on the scale here first, because this always trips me up.
Sure.
10 metric tons of HALEU sounds tiny, especially compared to the 100 million pounds sitting in NexGen's deposit that we just talked about. Why are traders on the desk sweating over a missing press release for such a small amount of material?
That's a great question, because on a purely volumetric level, you're right. 10 tons of HALEU does not impact the near-term natural uranium spot market at all.
Okay, so why does it matter?
Because HALEU is the crucial foundational fuel for advanced generation age-of-U reactors. Things like small modular reactors, or SMRs, and microreactors.
No, so it's about the future technology.
Exactly. The government's HALEU program is the highly visible proof of concept that underpins the entire long-term demand forecast for the 2030s.
Right, because if there's no fuel, nobody's going to build those next-gen reactors.
Bingo. So when the government misses a legally mandated deadline to provide that seed fuel, it deeply hurts the narrative of a Western fuel cycle that is executing on schedule.
Wow. Okay, so we've got NexGen staying quiet, the US DOE missing deadlines. The market is just waiting. But while we're waiting, there is this massive geopolitical wildcard ticking in the background.
The U.S.-Iran window.
Yeah.
Yeah, this is the thing that could jolt the market at any second.
Right, because we are currently 2 weeks into a 60-day negotiation window, and this was established by that mid-June ceasefire MOU and the framework to reopen the Strait of Hormuz.
Yes. And there were talks in Switzerland on June 22nd that advanced some procedural stuff.
But they yielded absolutely no published position on Iran's stockpile.
None. And that stockpile is the elephant in the room. We're talking about roughly 440 kilograms of uranium enriched to 60%, held at the Fordo and Isfahan facilities.
60% is, that is uncomfortably close to weapons grade.
It's a hair's breadth away in terms of enrichment effort. And this is where we have to clearly separate the two different premiums in the uranium market right now.
Okay, lay them out for me.
So we talked about the $95 term price. That holds the structural supply premium. That's the market worrying about next-gen and long-term mine builds.
Right.
But the $85.10 spot price, that is holding the geopolitical risk premium based entirely on the Middle East. Yeah. A ceasefire without a hard agreement on that enriched stockpile keeps the spot price artificially elevated because it doesn't resolve the actual threat.
It feels like Iran's 440 kilograms is basically the sword of Damocles just hanging over the spot market.
That is exactly what it is.
So if this 60-day window closes in mid-August and we don't get an agreement on dilution or, IAEA downblending, does that sword finally drop?
If the window closes with no resolution, you will absolutely see a violent reaction in the spot market. The risk premium will spike, but for now, the market is just holding its breath.
Holding its breath and staring at a calendar that is actively working against them, because all of these unresolved threads are slamming right into a brick wall this week.
The holiday calendar squeeze, it is brutal timing.
Yeah. Wednesday, July 1st is Canada Day. The TSX is totally closed, freezing all the junior equities.
Yep.
And then Friday, July 3rd is effectively closed because it's the observed holiday for U.S. Independence Day.
Right, which means Thursday, July 2nd, is the only full day of the week with both the U.S. and Canadian equities actually active.
Just one single day of real liquidity. Let's look at a snapshot of the Tuesday close going into this mess. Cameco was at $101.86, UEC at $10.69, Energy Fuels at $14.16.
And the Uranium EPF was sitting right around $56.18.
So what happens when the market opens on that weird, isolated Thursday?
Well, the market is facing massive liquidity compression. The tape is thinning out drastically because traders are on vacation.
Right.
And if Thursday passes without NexGen updating their timeline, or without the DOE finally releasing that HALEU list, the desk is going to be forced to carry this really awkward narrative into next week.
A sort of calendar met but delivery deferred vibe.
Exactly. It won't break the long-term thesis, but it will severely, severely test investor patience.
I can't even imagine the psychological toll on investors right now. Like, you've got these retail and institutional guys who bought into this summer 2026 narrative, expecting literal summer commencement, tractors moving dirt.
Yeah, they wanted to see shovels in the ground.
Right. And if Thursday comes and goes with just crickets, you really have to wonder how much of this flat $85 market is based on real conviction and how much is just holiday inertia.
It's a lot of inertia right now. Nobody wants to make a massive bet ahead of a long weekend when half the market is already at the beach.
Right, exactly. So let's summarize all of this for you listening, because there is a lot of noise this week. The main theme is this. The structural thesis of uranium remains absolutely rock solid.
Definitely.
And we know that because the term price hasn't budged from $95. Buyers are still perfectly willing to pay that $10 premium because the supply cliff in 2028 is real. But the execution of that thesis is currently gapping.
Yeah, and in commodity supercycles, understanding the subtle difference between a fundamentally broken thesis and just a delayed execution is the key to not getting shaken out of your position.
Exactly. Don't let the silence scare you out of a good position. But before we wrap up, you had a really fascinating final thought on all of this.
Yeah, just something for everyone to mull over this weekend. We are watching a Western supply chain that is currently priced for absolute perfection, right?
Yeah.
But it's executing on a delay.
Right.
So if this is how the market reacts, with flattened prices and all this anxiety, just to standard bureaucratic friction and a quiet AGM, what is going to happen to that $9.90 premium the moment a genuine, unexpected black swan event hits an already constrained pipeline?
Wow. Yeah, if they panic over a missing press release, an actual crisis would just break the scale.
Exactly. It's a powder keg waiting for a spark.
That is a brilliant point to leave on. Keep an eye on that term premium, everyone. Thanks for joining us for this deep dive into the midweek review. We will catch you on the next one.